narratives are misleading most of the time. Narratives by nature are things that flow on its own. They don't have a purpose. And in the stock market, we are overwhelmed with narratives and we try to make sense of them, and that is a dangerous thing. This is the Not Even Wrong podcast. It's September 7th, 2020. This is Krim Delko. Today is Labor Day, September 7th, Monday. We don't have an update. On Friday, Tesla was down 7% after hours because the S&P announced the rebalancing for this quarter, and Tesla was not included. From our point of view, this is relatively bad news because we expected Tesla to be included. We expect Tesla to be included at some point in the future. The demand and supply for now will probably shift more towards selling. However, we believe, and as we stated on Friday in several communications, that as a fund manager, we recommend that you either own the stock or you don't own the stock based on your desire to own it and not necessarily based on if the S&P includes it or not. And if you're a pure index tracker without fundamental views, you should not think about this too much. The day it gets announced as an inclusion, you should just buy the weight. If it's 300 or 800, it doesn't matter. You just buy it and you go with it. Trying to time the stock is impossible and not recommended. As far as we're concerned at Orange Capital Partners, we're most likely going to have to take another drawdown from our peak. We have stated many times in this podcast that we are managing our cost base in a way to be able to withstand large drawdowns. We are not playing the volatility on the up and down in a sense that we're adjusting our cost base and growing. We're not like a harmonica growing and shrinking. We try to be nimble and keep growing our wealth without necessarily paying attention to the daily moves. As far as the news is concerned specifically, we believe that the S&P committee is pretty prudent not to involve Tesla right now. It's okay to wait a few more quarters just to be sure that the earnings are stable, that the company is stable. It's a very large cap, so there is also the point that maybe giving fund managers a little bit more time to adjust to this new addition is prudent. But again, as a fund manager, I would recommend owning this stock. If you think fundamental, you want to own it for the reasons that we, for example, own it, you should just buy it tomorrow and not think about it too much. And if you're an index tracker, you should buy it whenever it's announced to the exact weight, and also nothing. Thinking too much about the daily moves is just not very productive because we believe that there's no purpose of that. And that brings me to the topic of today. It's the narratives. The narratives, the narratives, the narratives. We humans, we like stories. Today I saw a tweet by Nassim Taleb, which said something along the lines of, we take religion seriously and science we take only virtually, or something along those lines. And what he's trying to say is that we're really serious about the way we interpret religion, but we're not really too concerned about science, when in fact it should be the other way around. And the reason I think this makes a lot of sense, we humans, we are geared towards uncertainty, narratives, tales, stories, because our brains cannot fathom all the reality, and we're not Laplace's demons. We can't analyze all the information out there and make optimization judgments based on all the information. So what we do, we take shortcuts, and stories are a beautiful shortcut. And that's why we love narratives. And it's fine to follow narratives, for example, when it comes to things like the Bible, or even more archaic, like when the elders sit around the fire and tell us stories from the past. What they're really trying to tell us is how to behave in the future, how to avoid tigers, how to avoid bad marriages, how to raise our kids, fundamental things that we understand better with narratives than with scientific analysis, for example. But when it comes to the stock market, I believe the narratives take a very wrong turn. It's kind of like the wrong medicine for the wrong field. Like in the stock market, what we need is rules and cool analysis and purpose. Narratives are not very helpful. And the narratives can go either way. They can go to the negative. And Tesla is the perfect example. And by the way, it's not the only stock. Apple has been in that box, and Amazon has been in that box, and Facebook has been. Everybody has had their prime time of being the stock narrative of the day. Right now, it's Tesla. For example, on the weekend, there was the news that Elon Musk met with Herbert Diess, the CEO of Volkswagen in Wolfsburg. So Musk flew there with his private jet and test drove the IQ3 and IQ4 or whatever, some of those electric cars that Volkswagen has. And, that's fine. You can just take that as it is. In my view, there is absolutely nothing you see, you should not think even, you should think a little bit about it. And there's a certain things you can think about. For example, what could a deal between Volkswagen and Tesla entail? Does it make sense? This is an interesting case study. It's a business school case study, or if you're a fund manager, you can spend the morning thinking about this. And by the way, we had 2 meetings about this and spoke about this at length of what kind of deals Tesla could make to accelerate the advent of sustainable energy and transportation. But in the end, following all these narratives, for example, Volkswagen wants to make a deal with Tesla. Tesla wants to make a deal because they have to do this, because Volkswagen is powerful. You see, you can very quickly derail and become kind of a follower of stories. And we humans, it's kind of like an addiction. We like that, but it's not very useful because narratives have their own lives. They take their own shape, their own lives, and they start making us, first of all, they're kind of dizzying us, a bit like alcohol or weed. You smoke weed or drink alcohol, and you dizzy your rational thinking because the narrative is blurring your mind. It's nice. It's comfortable to listen to stories, either way, positive or negative, depending on which side you are. But it's not very useful. That's my point. It's just not very useful. What is useful in the case of Tesla is that what are the actual things that Tesla is doing to accelerate the advent of sustainable transportation. There are technology issues that they have to solve, keep building the innovation stack, solving problems, create new problems, solving problems. I don't think that there's any space for anything like Volkswagen or a deal like with Volkswagen. It's a waste of time. And that's it. That's the analysis. I think that's where the narrative should stop. And there's a lot of other things. For example, the stock split is being discussed and how it creates this narrative that other people are buying the stock because they think that other people are buying the stock. Look, you can't prove it. It's back to the name of this podcast, not even wrong. You don't have you're not earning your right to be wrong by talking like that. It's not scientific, it's not logic, it's not rational, there's no method behind it, there's no repeatability, there's no testability, there's nothing. It's just some words that you throw out there in the air by saying these things. It means nothing. Do you know what the market is really pricing? Do you know why Tesla is up? Is it up because of the Fed? Is it up because of the stock split? You don't know. But what you know, again, is what innovation stacks mean, what disruption means, what company culture means. You have facts of delivery numbers, you have market share numbers, you have customer satisfaction numbers. Those are things you can build on and create a valuation for Tesla for yourself. And then you can also, I think you need to think a little bit about the macro side and then make a judgment. And for example, for us, the stock value is between 400 and 600. I think we're comfortable with that. I think if it goes below, we're going to buy more. And if it goes higher, we're just not going to buy. We're not selling any shares because we believe that the probability for us to actually be right on a sale is very low. We've done it before. We've been right and sold and then bought back lower, but we've also sold and bought back higher. In the end, it's a wash. And the chance to, or the risk to miss another high reevaluation of the stock to the upside is way, way too high. We're also not shorting stocks in general because stocks like that, because again, the impossibility of high corrections to the upside makes a short way, way too risky. So to summarize, my point here is that narratives have their own lives and they're very entertaining and very helpful for us in certain ways when it comes to such things as values for your life. Like the Bible is a very good narrative, gives you an idea of how you should live your life, and you can either believe in it or not. You can either take those advices or not. But my point is the narrative is the right medium to tell that story, as opposed to, for example, an algorithmic program or something. This would be terrible. However, when it comes to investing, running a fund, and generating wealth, and the purpose of Orange Capital Partners is to generate wealth by investing in disruptive technologies with large impact. When that's your purpose, you cannot follow narratives. That's not the right thing to do because the narratives have their own lives, they have their own dynamics, and they can mislead you. We suggest that it is much better to build your thesis on a foundation, on a theory. Our foundation is built on 3 books: The Innovator's Dilemma, The Innovation Stack, and 0 to 1. From there, we build a model, which is we expect certain things that we then test against data. For example, in the case of Tesla, we have a model which is again built on the theory of those 3 books that Tesla fits into disruptive technology with large impact that will generate wealth. We then build a model that helps us test data. For example, part of the model is that they gain market share, that they outperform, that their competition is behaving in a way that Clayton Christensen suggests in The Innovator's Dilemma. So we have a lot of these data points that we can test the model against, and then we can conclude that there is a good chance that we are on the right path and that we have a chance to generate wealth by investing in the stock. The next level of analysis is that's the technical side, which is the expected return, the risk adjustment. So once you've created your thesis and you have a model, you will then create an expected return, which is typically based on the expected growth. No matter how much narratives you're exposed to, no matter how many stories you listen to, in the end, a stock follows its growth. So if you have a 40% CAGR over 10 years, there's a very high chance that your stock will do 40% CAGR over 10 years. If you have a 20%, it would be 20%. So in the case of Tesla, we expect 40% cumulative average return for the next 10 years, and that is our expected return. We do caveat this with risk, and then we compare that based on the opportunity cost of capital. We look at, okay, if we put our money in Tesla, then we can make an expected return of 40% per year, risk adjusted, so it's not just clean, there is risk there. But the alternative would be, for example, to buy real estate, to buy bonds, to buy other stocks. This is the kind of thinking we have to do as fund managers, and then we conclude we either buy the stock or we don't buy the stock. We have that same analysis with our CRISPR index, with Microsoft. Our options on Intel and RTX are a little bit different, but in the same realm. And in the end, this is how we believe running a fund that has a purpose to generate wealth has a higher probability of success than if you follow narratives. Thanks.